hosted these forums for several years now, and I think I'm on number 13, which is probably why my tech's been failing me recently. I'm always surprised that there's something new and interesting to talk about. And I went to see a brand new member yesterday in the construction field. So the roof light company up in Oxford, and the MD said that the pandemic had provided the burning platform that they needed for a change. I'm not entirely sure the pandemic would be my go-to for a new subject, but I think it's pertinent at the moment because I know what my speakers are talking about, and they'll be delivering, Simon, on leases. Companies are changing the amount of office space they need, and this translates across the whole of the sector. So residential, with people looking to work from home; office space, do we need it? Increased warehousing space, the face of retail, which I think Ian will be touching on as well. So that's kind of it from me. Without further ado, I'm going to hand over to Simon Knott, partner at Penningtons Manches Cooper. Thank you, Simon.
Morning, everybody. Have you ever woken up in the morning and thought to yourself, why the hell did I agree to do that? Because between you and me, that's how I woke up this morning. I think it was a few months ago that this little devil in my head told me that I should lead by example, when I actually haven't been outside my office or seen more than 5 people in the last 18 months. But anyway, I'm here now, and thank you very much for coming and listening, and I hope that I'm going to make it worth your while. My name is Simon Knott, and I'm a partner with the law firm Penningtons Manches Cooper, and I'm the head of the commercial real estate team here in Oxford. Over the course of the last 18 months, the world has changed. I mean, you don't need me to tell you that. But we have this new buzzword that's agile working. I don't know exactly what agile working means, but I do know that it means that I'm not allowed a desk of my own. I'm not allowed enough desks for the members of my team. And most importantly, and very, very upsettingly, I'm not allowed a pot plant. It also means that we're not going to realistically be in the office 5 days a week. And consequently, we probably have too much office space. We're quite lucky because our lease comes comes to the end of the term in 2 years' time. And as such, we've got time to sit back and see how the world pans out before we need to re-engage with the landlord and discuss terms for a new lease. But I'm conscious that we're not the only company in the world that's having these deliberations, and that you will almost certainly be thinking much the same. So the purpose of my talk here today is to really explain to you how you might shed some of that spare office space. And I'm going to have a quick rattle through the lease. Now, over the, it's gone black. I hope you're still there. My screen went black, so don't know whether that was a technical glitch. It seems obvious to me, but I'm really conscious it's not obvious to everybody, that a lease is a contract. And that just because a contract turns out to no longer be a good contract, you can't simply get out of it. And this is, over the course of the pandemic, I've had this discussion relating to rents, and I realise how upsetting it is, but it's a contract. So that's where we need to start. The terms of the lease that you agreed 5, 6, 10 years ago, they're all important. So we're going to turn to the lease, and there's 5 ways of getting out of it. The first one is an assignment. You'll turn to the assignment clause, and it will hopefully say something along the lines of, the tenant may assign the whole of this lease, and if it's been drafted correctly, it'll say, with the consent of the landlord, such consent not to be unreasonably withheld. Now, those are the magic words that you're looking for, because, as it suggests, the landlord cannot unreasonably withhold his consent. More importantly, he must consent or refuse and state the reasons why within a reasonable period. So you find someone who's willing to take over your obligation. Sorry, I should have started with that. An assignment is where you pass over your obligations to somebody else. They step into your shoes and you walk away from the lease. So you've found someone that actually wants your premises, they think it's rather good and they're willing to take over. So you write to the landlord, and I would suggest that you write rather than anything else because you want to set the clock running, to introduce this person and ask for consent. The landlord is entitled to consider what's known as the covenant strength. So can this person, are they reasonably expected to be able to pay the rent and comply with the lease covenants throughout the remainder of the term? And it doesn't matter that they're less able than you, or it doesn't usually matter. It just matters whether they can reasonably be expected to do those things. So assuming that you have this clause and that the landlord is in principle happy with this person taking over, he will wish to impose some conditions on you. And looking at your lease, I'm pretty sure that if it's modern, it will say something along the lines of you have to provide an authorized guarantee agreement. I hope that it says, if reasonable, you have to provide it. An authorized guarantee agreement is a guarantee. You're guaranteeing that person you're putting up to take over from you. But you'd rather not do it. As the outgoing tenant or the assignor, you don't really want this residual liability on your spreadsheet. So if you can agree reasonable. He may also want a rent deposit from the incoming person or guarantees, but again, I hope that your lease says reasonable. The second way you can get out of a lease is underletting. This is slightly different in that you continue to be the tenant under your lease and you grant a new lease to somebody else. The good news is that it's a lower test. The landlord will find it harder to refuse an application for license to underlet because on the face of it, he now has two people that he can chase if one defaults. If you don't pay the rent, you go after the under tenant. So there's been many situations in the past where we've applied for a license to assign, landlord says no, and we move to an underlease. So again, you need to look at the lease and it will hopefully say something along the lines of the fact that you may underlet the property in whole, or possibly it may say or in whole or in part, with the magic words, such consent not to be unreasonably withheld. So the landlord's happy with this person in principle. And again, you need to look at the conditions that you might be asked to impose. It might say that you need to exclude the lease from the 54 Act, which means that the tenant won't have security of tenure. Now that in itself is not a particular problem, but ideally it's not in there because it will narrow the pool of people who are willing to take on the property. If there's only a couple of years left to run, there's costs involved in moving, and the person coming in doesn't know for sure that they'll be able to renew their lease at the end of the term. The other clause that I'm looking for that is perhaps more important is the rent that you must charge. It will say something along the lines of the reservation of a rent which is not less than the open market rent. What I don't want to see, and I hope that you don't see, is not less that it must be higher than the passing rent, i.e. the rent you're paying, or the open market rent. Because what this means is that you can't charge your undertenant less than you're paying. And in hard times, it might be quite attractive if you're paying £10,000 a year to lay off some of this cost and charge your undertenant 5. I appreciate it's not ideal, but it's something. Now, the third way you can get out of a lease is a break clause. And I'm really only going to say 3 things about a break clause because you've either got one or you haven't. If you've got one, diarise the date. It will say something along the lines of, The tenant may terminate this lease by serving a break notice on the landlord at least 6 months before the break date. If you miss that date, even by 1 day, you have no break clause anymore. That is the end of the matter. And a plea from my litigation partner, please don't leave it till the last minute to serve that break notice. The second thing I'm going to say is that when you're negotiating the lease, you need to make sure that the conditions that have been imposed are ones that you think you can comply with. There's plenty of case law on this, and the rather silly example that's often quoted is that if it says you must serve the break notice on pink paper, you must serve it on pink paper. You may have a very favourite blue pad, but if you serve your notice on blue paper, your break clause will fail. In the real world, of course, what it will say, it'll have some other conditions, and the only ones that I really want you to see in your lease are that you've paid the annual rent. Now, that's not all rents, I just want annual rent, because you know what that sum is, and therefore you know whether or not you've paid it. Incidentally, be very careful, because non-payment for COVID reasons is not a defence. The statutes don't help you, and if you haven't paid the rent up to date, your break clause will fail. I'd also like to see vacant possession, or you can agree vacant possession, but those are the only two conditions that ideally we would see in your lease, because you need to comply with them, absolutely. And the third thing I'd like to say about break clause is that however tempting it may be to save some money, never, ever, ever serve the break notice yourself. Approach a lawyer, and this isn't a shameless sales pitch because there's plenty of good lawyers out there, but it will be the most expensive cost saving that you ever try to make. In my team, we would never, I'm a non-contentious person, but we would not serve break notices on behalf of our client. They always go to the property litigation team because it's so easy to get it wrong. Fourthly, surrender, just very, very quickly, because I'm conscious I'm running out of time. A surrender is where you give the property back to your landlord. You can only do it by mutual agreement. If there's time left to run on your lease, your landlord is going to ask you for money. Unless, of course, your property is a prime development site, or he thinks that he can get, or it's under rented and he can get more money out of somebody else. In reality, of course, most landlords I know, no disrespect, will ask you for a premium anyway. So you'd be well advised to, because he will bank on the fact that you don't know it's a prime development site. So I'd suggest that you instruct a surveyor to negotiate this surrender premium on your behalf. Lastly, and the fifth way, perhaps rather obviously, is a fluxion of time. If, like us, your lease is running out, you think you can walk away in 2 years' time, just be very careful, because business tenancies do not expire on the date that it says in the lease. Now, that's a slight simplification of the law behind it, but let's just say my lease says in it that it runs out on the 25th of December this year. The landlord could potentially charge us for rent beyond that period, and that could come as a very nasty surprise to you. So if you know you want to give up your lease at the expiry of the term, then I would suggest that you serve what's called a Section 27 notice to make sure that there's no call for rent. It could be 6 months quite easily. But anyway, on that note, it hasn't proved to be as bad as I thought it might be being here with you today. And I hope that it's been interesting, if brief. Sarah, can I hand back to you? How's that?
You can, sorry.
I thought I'd just be talking to myself, Sarah.
No. And I'm sorry your screen went black. The rest of us could see it quite happily, I hope. Please nod. and say if otherwise. I'm glad that you're not contentious. I don't know if the pot plant in the background might be contentious. I'm guessing you didn't go into the office. I do have some questions regarding what you said, but I'll keep those for the Q&A. If I may now hand over directly, Sarah, if you could click on for Caroline Fleet.
Good morning.
Crowe. Thank you.
Good morning, everyone. Thank you. My name's Caroline Fleet, and I'm head of the real estate sector at Crowe, and I'm joined today by my colleague Mark Stemp. So apologies, I've got a frog in my throat as soon as I start talking. So I am going to talk this morning through our Outlook survey. So I'm going to have a look at some of our findings on our survey. And then Mark is going to pick up on some tax and conversations that we're having with our clients. So for those of you who don't know who Crowe are, we are a top 10 accountancy firm, and we will do all the things that you would expect a accountancy firm to be able to do. So we will provide audit, we'll provide tax advice, and we will also do financial services, corporate finance and risk. As well as being a national firm, we are also part of an international network. So I think everything in yellow is what the firms that Crowe have fellow firms. So we have an international reach, and we work across a network. So if you are looking to do investments overseas as well, we can help with that. Or if you're an international investor coming into the UK, we can also help on the other side. So if you can probably move on to that one. That's just more details of what we do. So I just wanted to talk about our Outlook report. So we do this report normally on an annual basis. I have to admit we didn't do it last year. Probably there was much more things going on in people's minds, and who knew what we were going to be able to say. So, but over the summer, we reached out across our network and across our clients, and we've had over 100 respondents. I would say that the responses across lots of the class of assets. It's a real mix of commercial and residential developers, investors. Over a third of the respondents had a portfolio of less than 5 million, but over 37% had over 50 million in terms of portfolio size. So really all it's going to give us, it gives us a nice snapshot of what are people feeling, what are people thinking. And you are the first guys to actually hear all these findings that we've got so far. So I'm going to have a look at how has the real estate sector been impacted over the last 12 months, 18 months. Then have a look at how people are feeling more long term. What are people saying that they're saying their opportunities are? And then just picking up on some of the key changes or influences on the market, just looking at finance, government and tax policy, and also what we've seen that clients telling us is becoming more important on their agenda. And that they're beginning and they're focusing on, and what they think will be the game changers of the future. So if I look now at which sectors of the portfolio have been most impacted by COVID-19. Now, this was the question we asked our clients, and it'll be no surprise to any of you, I'm sure, that actually the one that was highlighted as the most impacted was the retail. Now, it's over 34% said that retail was the most affected, closely followed by the office sector. Now, I think that those sectors were already showing stress before COVID-19, and that is certainly reflected in our earlier survey reports. What I think is interesting, if I look at the retail and the office figures, is actually, if you look at the retail, there's not much difference between the regional and the London, as in there was stress anyway. Previously, we had a much stronger differentiation that regional retail was suffering more than London was as a retail sector. However, that's the reverse if we look at the office. So what's actually our respondents were saying was actually the office sector in London was the most impacted, obviously, in the last 12 months. So that won't be a surprise with with most offices closed and everybody working from home. And that is also, I think, true of returning to the office. I think London is taking longer to get back up to speed. What, however, I think is interesting is that over 50% of our respondents are not looking to change their portfolio balance at all as a result of COVID-19. So I think there is a lot of that COVID has maybe highlighted, accelerated, or I think Sarah said burnt down, so the trends that we were seeing anyway, and that is certainly borne out by what our survey is telling us. What I think we will see, and is, we are expecting to see more repurposing of assets. People are looking at changing spaces, changing places, looking for more diversity. And, as Simon was saying, when we start looking at leases and office leases, I think what we're going to see is we're seeing shorter leases coming into play as well. So I know that Savills did a survey recently, and actually over 85% of new leases are less than 5 years. Now, whereas if you looked back about 5 years, that was less than 30%. So I think what we're going to see is it is this idea of more agile. It's not just agile working. I think it's the properties that are also going to be more agile. And landlords are going to be much more active in their asset management when they're looking at them. But in terms of actually the sectors, and I see that there is something in the chat underneath, it's not all sectors that have been under stress. Some have done very well as well. There's no doubt that the logistics, data centers, there's huge demand for them, and they're still, they have done very well during these COVID times. But the question we'd asked is which was the most impacted, which was clearly going to be retail, which is not a surprise. But if we look forward to what's the long-term view, actually, I would say there's general optimism for the future, that when we ask our clients, do they expect their businesses to be growing or maintaining, that there's only 3% that consider that their business is going to decline over the next 12 months. So there is genuine optimism long-term about the business. Most of our respondents still say that they're expecting property prices to increase. Over 57% say that they see it in residential, but they're expecting an increase of sort of up to 5% probably in the next 12 months. But that's not to say that it isn't with a few challenges or bumps on the road. What the most significant challenges that our clients are telling us in relation to what's going to affect their business, there is still the same comment of is the general economy and consumer confidence is the biggest impact on their business. So that's 37%. Now, if I look back at previous surveys, that is higher than it has been previously. However, in previous surveys, the previous survey, it was all about Brexit. So I think that if I added Brexit as a risk as well, it's there at similar amounts. It's the 40% type level is the general economy and where we were going. What has shown a significant increase, though, is a concern for businesses are these increasing construction costs and the lack of labour availability and how we're going to be able to deliver. So that has shot up significantly in terms of a risk that businesses are identifying. Probably a short-term concern and risk, well, hopefully short-term, is the rent moratoriums and whether those will come to an end. Commercial landlords are now faced with, an extension of that rent moratorium till at least March 2022. And that is obviously going to play on minds for at least another 12 months. And planning regulation always makes always gets a percentage hit on there. So, but I think really, everyone is the long-term optimism is how I see it. But there's a lot of uncertainty at the moment. So if we look at where are people looking to invest, actually of our clients, most of them are only looking at the domestic market. They don't consider now is the time that they would look to invest overseas. And in line with actually our earlier surveys, the regions that they think they're looking to invest in is still very strongly in the southeast. And London. So London has dropped a little. So London previously was at 20% in earlier surveys, it's now gone down to 15%, but the southeast has remained the highest and continues to be. The southwest, I would say, is the other area that is still a hotspot. Previously, I think it was pipped to the post by the northwest, but southwest is where they're now saying it. Linked to that, where are the asset classes that they're looking to make investments? These ideas of storage, sheds, they are the most popular, and residential. That's where people are seeing the returns to be made. We are still not building enough houses, and we're falling short of our 300,000 that we've set, the government has set as a target, and therefore there is still great interest in the sector. I think it's interesting to look at new entrants into that market, into the build to a rent sector. Who would have known that John Lewis and Sainsbury's would say that they are going to build, that they are going to enter into that sector. So they are looking, at redeploying their sites that they may have previously have thought that they were going to put properties on, retail outlets, now that they will look at building residential sectors. And I think that will be a continuing trend. Obviously, one of the key factors when you're you're looking to build is raising your finance, whether you're an investor or a developer. So we ask our clients, where do they get where have they been able to get their finance from? And as you'll see, the majority is still coming from the main banks. What I think the conversations that I've had with my clients is, if you've been in a sector that has been badly affected by COVID, a lot of the banks have tried to be helpful in terms of if there have been breaches of bank covenants, and looking to work with clients. And it's much more what's become more important is this relationship banking and this idea of working with your banks. One of the things, just because of an accounting background that we have, is actually if you've got a breach of your banking covenants, and that is in place at your year end, actually, unless you have taken action and had those open discussions with the banks as to what the remediation is, it has to move to a current liability. So I think on all of that, it is just saying, having those conversations with the banks early on is really important, because it can influence your financial statements. Certainly, what the conversation I've had with clients as well is it is harder now to access new finance, but it is available, but it is probably at a higher cost than it was previously. And I think on all of this, what clients are telling us is it takes longer to obtain the finance as well. So making sure you have those conversations early if you're looking for a refinance, and understanding exactly all the information for the banks, or the just so that you start that process early. We did also ask our clients as well about their views on interest rates, and the consensus is well, nearly 50% are saying, that low interest rates have become so much the norm that any increase in the interest rates is going to severely affect basically the business, the retail sector, the real estate sector. If I turn now to government, and we asked our clients about what was the best way that government could support the high street and the housing agenda. And I think particularly I'm going to say this is biased obviously towards the retail sector, is that business rate reform still remains the most important way that everybody sees that government should be supporting the high street. Now, clearly they have announced that they're looking at a reform and they're looking at more frequent valuations to take place. We would expect that will be pushed through. It will be interesting to see what Michael Gove is going to do now. He has just been appointed the new housing minister as of yesterday. So it'll be interesting to see what take he has on that. The high street, what we're going to see in the high street and housing is, government support over COVID, that is slowly going to be withdrawn. So we have clearly, they have had business rate holidays. There've obviously been the CBILS, there's been the furlough scheme and various deferrals of various taxes, but all of that support is going to be slowly withdrawn. So I think, engaging tenants and landlords being engaged is still very important at this moment. There is still much volatility, I think. SDLT still continues to be a contentious matter with residential developers, and I'll have a look a bit further about that. Planning reform, always the idea, actually, if I talk to my clients, that actually just getting things through planning is going to have taken so much longer during the pandemic, and that extension comes at a financial cost, and that is a concern for them. If I talk about now what the tax barriers that people identify as to growth, the increase in corporation tax rate is, it's 19%, and it's going to be going up to 25% from 2023, and that is the highest rate we've had for over 10 years. So it was last like that in 2011. So that is clearly an adjustment that has to be made to people's business models. To soften the blow slightly of that increased corporation tax rate, we have got these super deductions for capital allowances. So if you incur qualifying spend, you can have a deduction up to 130% up to April 2023. And the good news is following lobbying that also applies to property investors. So previously, when it was first introduced, it wouldn't have applied, but it has been amended, so it does now apply. So if you thought you weren't be able to get it, you will be able to now. SDLT, as I said, SDLT is, we obviously had the SDLT holiday, and I think if you look at what that has done is it's accelerated transactions, and we had the quarter just before the end of the holiday back in June was 175% higher than the previous quarter in the previous year. So there were lots of lawyers who were very stressed to try and get everything done and over the line in time. Now, the problem I have with SDLT as an incentive to open up the market is that it does lead to huge peaks and troughs when they start doing these holidays. And then what it's not doing is it's not actually increasing the supply, the housing supply to the market. So whilst it helps open up the market, it also has a tendency to make it highly volatile for a while. The other tax that probably is worth mentioning is that they are looking to introduce a property developers tax, which is aimed at the very large housing builders, which is looking to raise 2 billion over 10 years, which is being, well, they're saying it's ring fence to pay for all the cladding. So there is going to be a property development tax, and there's also going to be a further levy. So for the larger property developers, that is something that is currently being consulted on at the moment. If I look forward as to what is everybody saying is the next big thing, what are they looking at? And sustainability has certainly become more important and I think it's become more important to investors. I think it's become more important to the tenants, and that is something that our clients are increasingly putting higher up on their agenda, looking at their practices, looking at their properties, how can they demonstrate their sustainability. Now, I think it's interesting that there's lots of regulation, and there's lots of there's lots of regulation, and there's lots of market demand in this area. This is one area that I think, if I look at the tax world, because I'm a tax partner, I look at it, is actually there's no tax incentive these days. There used to be good tax incentives to be environmentally friendly, or to do brown sites, or to use, but that there isn't any of that at the moment, which I think is quite interesting. Our clients are also telling us that technology is also still very key, and they're looking at how is that affecting their different asset classes. And we've got this idea of smart buildings and modern methods of construction. So there is much more that is still changing, and these are, I think, not affected by COVID and the last 18 months. These were trends that were coming through anyway. So I guess I think from what my clients are telling me is we're going to be more agile, more actively management. I think it's this idea of more flexible and actually more engaged, whether that is talking to your banks, whether that is talking to your tenants. But it is general optimism for the future. So hopefully those are interesting highlights for you. I'm now going to pass over to my colleague Mark, who is going to talk through some of the tax conversations we're having with our clients.
Thank you, Caroline, and good morning, everybody. So my name is Mark Stemp. I'm also at Crowe. I'm based in the Reading office of Crowe. I generally talk to landlords about their personal taxation position. So it's usually with regards to residential rather than commercial property portfolios. But commercial is something that people are including in their portfolios to a certain extent. I'm going to be talking to you about 3 different things that we're talking to our clients about at the moment, but just to set the scene with regards to property taxation. We had, for a period of time, plenty of property tax changes, and you'll remember landlords, certainly with residential property, were hit by the loan interest relief restrictions, so they're all paying a bit more income tax than they had previously. They've now started to be impacted by the fact that when they sell a property, they've got to pay their capital gains tax within 30 days, and they've got to do a tax return in 30 days. While we did have the stamp duty holiday, we have also had the stamp duty increases, and certainly with regards to the 2%, if you're a non-resident individual, there's a 2% surcharge when you purchase resi property, and we had the 3% surcharge coming a number of years ago. So tax changes, there's lots and lots of them. Landlords are constantly impacted, and the way that they're assessing their investment decisions are pretty much based on how much is going to end up in my back pocket over a particular period of time, and to really just think through all of the different taxes. So the 3 specific areas I wanted to talk about today, and the questions that I'm getting more and more from clients, is first of all succession planning. So what I mean by that is, unfortunately, COVID has meant people have been experiencing close ones' illness, perhaps even some death, and they're sort of thinking, okay, I'm still comfortable with the property sector, but when's the right time to pass on my portfolio? How do I do that? Do I turn it to cash and pass the cash on to the kids or not? So I'm going to talk through that first of all. I'm then going to very quickly, with one slide, talk through the inward investment. So we've got some people overseas still seeing the UK property as a safe way to store their wealth. And lastly, and it's a question that I get nearly every day, I'm thinking about buying another rental property. Should I use a company or should I own it myself? And just to talk through the tax impact of both of those. So succession planning. So as I mentioned, the pandemic has meant people have been looking at their wills. Certainly private client lawyers have been very busy with their will banks, redrawing some wills and sort of just thinking through, if somebody does die, what's going to happen to their wealth. Inheritance tax being one of the main drivers around, okay, I didn't quite think I was going to die, but maybe I might sooner rather than later. So they are bringing their planning forward, and they're basically saying, okay, if I'm going to pass this on to the next generation, how am I going to achieve that? If I do that because I die, then we've got inheritance tax to pay. So while you can do some planning for married couples around the spouse exemption, once there's one of the two dead, once the second one goes, we've got inheritance tax. And inheritance tax rates are typically two rates. You've got the nil rate band, so a nil rate of inheritance tax on the first £325,000 of assets when you die, and anything over and above that, there's a 40% tax rate. So what people are saying is, well, can't I just give my property portfolio away now, because then I won't die with it, and therefore I won't pay inheritance tax. And broadly speaking, so long as you make a gift, a proper gift, survive the gift by 7 years, yes, you do avoid the inheritance tax. You've just got to structure the gift correctly. There is a relief where you don't pay inheritance tax, where you've got a property development business rather than be a landlord owning property. So if you're purchasing property, doing property up and selling property and doing that a number of times, that's seen as a trade, and you get no inheritance tax when you're passing a trade on death. Whereas if you're a landlord receiving passive rental income, then that rental income, that basically means you're in inheritance tax when you die with that portfolio passing it across to the next generation. As we've seen before, we're not necessarily seeing people sell, but what we are seeing is we're seeing people want to transfer onto the next generation by simply gifting property onto the kids or grandkids. And I'm going to go through that scenario in a second. Sometimes it's not straight to the kids. Sometimes they don't trust their kids, or the kids are too young. So they use other structures such as trusts or something called a family investment company. So here's a really simple example as to how people can transfer property onto the next generation. So let's say we've got a married couple here. They've got a rental property they've identified they don't need anymore. They've decided they want to pass it on to the next generation, and it's worth about 600,000. So effectively what they're doing here is they're saying, okay, got the property, let's do a proper transfer across to the children. Because we're doing a proper transfer across, we've not got the rental income anymore. So they won't be receiving the rental income. The kids receive the rental income. We can't control who our tenant is. We've passed that decision on to the next generation. One of the issues of transferring the property is you've got capital gains tax to pay on the increase in value since it's in your hand. So if it was me passing it on to my children, I'd have to pay capital gains tax on the growth of that property. And the capital gains tax rate at the moment is at 28%. But I would have thought that tax rate has got to go up at some point. The question is, we're not sure when, but we do see that likely to go up. From an inheritance tax point of view, we're saving inheritance tax. If I give £600,000 of home away, this rental property away, then I'm going to survive by 7 years. I get a tax saving at 40%. So I'm going to save £240,000 of inheritance tax, but I've got to pay the capital gains tax instead. And there's no stamp duty so long as we haven't got a mortgage here. So a gift is something that it's quite straightforward to do, but does cause capital gains tax. What some people do in order to either not have the capital gains tax, or usually because they don't necessarily trust their children, either their children are too young or they haven't, in their view, married in the right way or to the right people, is they basically say, okay, rather than give this straight on to the kids, what we'll do is we'll transfer an asset to a trust for the benefit of the kids and the grandkids. So it's a way to still pass the asset on and reduce our estate for inheritance tax purposes. Because we're gifting the asset onto the trust, we still don't get the income because the income goes into the trust for the benefit of the kids and the grandkids. But we can, if we want to, still have some control over that asset, choose who the tenants are, choose when we repair, those sorts of things. But one of the tax angles here is that when you transfer an asset to a trust, you don't have capital gains tax. Whereas if we just gave it straight to our kid, we would have capital gains tax. The capital gains tax doesn't disappear. It's simply saved for eventually when the property is properly sold in the future. So the tax is deferred until a sale of the property in the future. So when eventually the asset goes into the trust, and then the trust pass it on to the kids, and then the kids sell it, at that point, there'll be the capital gains tax to pay. But we've still got our inheritance tax saving. We've saved inheritance tax on the £600,000 of value and saved tax at 40%. So we've still got £240,000 relief there for inheritance tax. So just something just to think through with regards to inheritance tax planning. And it is a common theme, certainly while the pandemic's been on, to be thinking about passing property on to the next generation. The second topic I've been talking to people about, and so this is money, typically the people I've been talking to, so people in Dubai, people in Hong Kong, people in Singapore, and the main, probably over the last couple of months, the questions that I've had from people. So these are non-resident people, so people not living in the UK, that are identifying the UK as an attractive place to invest money, and they'd like to invest in UK real estate. And the tax legislation is actually pretty positive for investing, for non-resident people investing in UK property. We've got quite a special tax regime, which is fairly unique in the world, that basically says if you're a non-UK person, something called a non-domiciled person, then you're only charged to UK tax on UK income. So as the income from the property, we've got UK tax to pay, but the UK tax office isn't going to ask about your Dubai income or your Hong Kong income or any other income in any other territory around the world. So it's a way to remain private from the UK authorities and only pay UK tax on the UK things. And so if we're identifying a property portfolio which is receiving some rental income, then they'll effectively, in the UK, they'll be charged a tax. They'll get their basic rate band on their UK income, and then any higher rate band over and above £50,000 of income they'll be paying. So they're not having to disclose the rest of their assets. We obviously recently had the increase in the SDLT. There's a 2% surcharge for non-resident people. And so while that still needs to be factored into the numbers, that doesn't appear to be putting anyone off. Everyone seems pretty prepared to be paying that. And it wasn't that long ago, so back in 2016, non-resident people wouldn't be subject to UK capital gains tax at all. They dragged UK residential property within capital gains tax for non-resident people in 2016, and commercial property from 2019. We are seeing offshore structures in the past being shut down, and I think this is real objective by the government and the UK tax rules to basically say, look, if you're going to own UK property, just own it through a UK structure. Don't be too clever with that. And they've taken away the majority of the reasons to be based offshore. The last thing I just wanted to mention is there's an analysis between sort of corporation tax and personal tax. Some people want to own in a company and other people would prefer to own it themselves. The last thing I wanted to talk about, and it's a question that I get, as I say, pretty much every few days, is looking to acquire another residential property that's being let out. Should I own it myself or should I own it through a company? So if we just basically just talk through, well, should I own it through a company or not? So we've got there's two individuals here, so husband and wife, basically saying, okay, I've decided I'm going to purchase a residential property. I've rented it out. I'm going to pay tax on the rental income, and the corporation tax on the rental profits there is at a 19% tax rate. So the corporation tax rate at 19% compared to if they owned it personally, it'd be on top of their other income. So they'll probably be a 40 or 45% taxpayer because of their other income. So corporation tax in a company is cheaper usually than owning it yourself. And it's the same as eventually if they do sell the property, you've got corporation tax to pay at 19%. And as Caroline alluded to earlier, the tax rate's going up to 25% in the future. But if they'd owned it personally, there's a 28% rate at the moment. So corporation tax is still less. The part of the analysis most people miss out is it's the company that has the rental profit. And so if you wanted to spend it on yourself, on daytime living or cruises around the world, if you're able to escape the country, then you have to take money out of your company. You have to pay dividend taxes. And to pay dividend tax, you've got to pay the extra tax on taking the money out of the company. And by the time you add that onto the corporation tax, it can start to become quite expensive. And we've just had this new levy introduced, or they're talking about being introduced from April next. So there's a dividend tax increase of 1.25% to pay for social care from April 22. So factor in most of this stuff, but in very simple terms, the answer usually is, so long as you've got enough rental property profits, usually a property company is definitely worth considering and worth thinking through. The last thing I wanted to talk about is the fact that for most people, they want to have a rental profit within the company. They then say, well, who should own the company? And with regards to owners, some people decide to add the family on there, and that's called a family investment company. And the benefit of having a family investment company is you're sharing the value for inheritance tax purposes amongst all of the family. So it's not in your estate only, it's in a number of different people's estates for inheritance tax purposes. So we could share amongst the kids and yourself and grandkids, for instance. And that also means you can share the income in a different way as well. So not only the decision, should I be a company or not, but if it makes sense to be a company, should my shareholders be my children or not? When making the decision as to whether to be a company or not, I'm just going to quickly go through the blue line there. The analysis you're effectively doing is you're saying, okay, I'm making rental profits of £100,000. If I'm a company, after paying corporation tax, I'm going to end up having £81,000 left over. And if I take all of that money out by way of a dividend, I've only got £54,000 left over. So actually leaving money in a company, it's really good to be a company. As soon as you put the money through a company and take the money out of a company, you end up with a bit more than half left over in your back pocket to spend. That is, however, when you compare it to just owning it yourself. And if you're a 40% taxpayer, you'd end up with £60,000. So if you were just a 40% taxpayer, you'd be better off owning the property yourself instead of through a company, if you wanted all the money in your own name. For the majority of people, they're not 40% taxpayers. If you've got some rental, some interest being paid to the bank, I've seen clients pay tax bills in excess of 100% of their income because they're highly geared with their bank interest. So in most cases where you've got a rental portfolio, a company is definitely the thing you should be considering. The last thing that I talk to clients about, and this comes up pretty frequently, is, okay, I've decided I want to be a company, but I've got a load of property that's not in a company. How do I get it into my company? And there's lots of traps here. So it's really important that people take advice when they're saying, right, I want to be a company. I've got a load of property I want to put into the company. If you're putting existing property that you own into a company, there's capital gains tax to consider on the growth. You've also got to think about paying stamp duty, land tax all over again. There are some reliefs from both of those taxes, but there are very focused reliefs and certainly not for everybody. So just bear in mind, it might be sensible to purchase newer property acquisitions through a company, but if you've already got something outside of a company, it might not make sense to transfer across unless you're transferring large portfolios that you're actively involved in. Otherwise, you'll end up with capital gains tax or stamp duty. So that is my discussion for today. I saw a few questions come in that maybe we'll pick up in the question and answers a little bit later.
Thank you so much,
right.
Mark.
No problem.
Thank you. Very insightful. So we're going to trot straight on because I am conscious of the time and these things always overrun. If we can hand over, Sarah, if you wouldn't mind, straight to Ian. I can't see on screen, Ian, from Aitchison. Oh, there he is. He's back in the room. Aitchison Raffety. Sarah will find this. There we go. And happy days. Well done, Ian. You put our logo on your slide deck.
Yes,
it's going to be a bit of a gallop through, but rest assured, audience, that questions, if we don't get to them, will be shared with the with our speakers. So over to you, Ian. Thank you.
Yes, thanks, Sarah. As you say, I'll try and canter through this as quickly as possible. Thanks firstly to the other presenters this morning. Some really interesting stuff there. And thankfully, it's pretty consistent with the sort of stuff that I'm about to say. By way of intro, I'm Ian Wimpany, head of the Valuation division at Aitchison Raffety. We're a national chartered surveying firm with multidisciplinary practices across the country, having specialisms in healthcare and education. I'm based out of our London office, but we are, and this was pre-pandemic, we set ourselves up with a flexible working platform. So I generally frequent lots of different offices and work from home quite a bit as well. In terms of the presentation for this morning, just planning to talk a little bit, as you can see, about the economy, give you a brief overview of that and my thoughts around it, talk about some general real estate trends in terms of some of the structural shifts that have already been alluded to this morning, and then finally provide a bit of market focus on the Thames Valley region. So kicking off with the economy, I mean, surprisingly, when I was putting together this presentation, most of these indicators are positive, and which is quite heartening. I mean, you read a lot of the headlines and it can be, a lot of doom and gloom, but actually reading between the lines, there's a lot to be positive about, and going forward that we can use. So when we look at things like government borrowing, we see there are nearly record levels, almost record levels, 300 million, the biggest deficit since World War II. But the interest levels and the prevailing interest rate environment are really keeping rates not just manageable, but almost at the most affordable they've ever been. So that's really encouraging. When we look at things like the purchasing managers index, it's a touchdown from an all-time high in June, but remains comfortably in positive territory, which again is an indicator to generally how everybody's feeling, and in terms of the positivity about the general market going forwards. Similarly, when we look at employment statistics, these paint an encouraging story. We've got employment rates already going up, and unemployment going down. But alongside that, I think what's important is that we have job vacancies at an all-time high, and that's particularly important with the end of the furlough scheme in mind. And that may mean that some individuals require a degree of retraining, but there are opportunities there for them. Obviously, I guess the elephant in the room is inflation, because it could bring down the house of cards in terms of interest rates, because I think the low interest rate environment is really underpinning quite a lot of the positivity. What we're seeing in inflation so far is it is increasing, and I think a lot of that was anticipated anyway. Most commentators do believe, however, that will be short term, and I tend to agree with that. So it's not something that's going to, I think, stick around, but it's certainly worth keeping an eye on, just in case it does become a bit more stubborn than expected. And in the face of all of this, the GDP forecasts are reasonably positive. And whilst we can say that a lot of uncertainty has been removed from the Brexit situation, I think we'd all admit there's still quite a lot of work to do to ensure the continued stability of supply of goods and products and services between the two economic areas. So yeah, kicking on to the macro real estate and market themes. I mean, I think here the big headline is obviously around the structural shifts. I mean, these are things that were, and I think this has been alluded to previously this morning. But these are things that were in flight pre-pandemic. But I think what's happened is that they've just been accelerated through necessity. So for me, obviously, retail has been the obvious loser. With stores being forced to close and people becoming a lot more comfortable with online shopping. The high street in particular and shopping centres were really bound to suffer there. I think it's expected that e-commerce will remain a big part of the market post-pandemic. How much it will be, who knows yet. But certainly people still like to get out of the house and go to the shops. But I think there is a convenience factor that around online shopping that will remain, and businesses will need to modernise and to suit this new trend. With regard to the high street in particular, I think, there's still an element of it waiting for the return of, the workforce, if you like, to city centres. And, as Simon was saying earlier, this may not look like it used to, and probably will not look like it used to. But, there will be a return at some point, and, it'll be interesting to see how the high street recovers or develops and moulds itself at that time. I think, the general theme will be for less but better floor space, and there'll be a real consolidation of operators out there. On the industrial side of things, industrial has been the clear winner. It was enjoying a strong performance pre-pandemic, and the progression of e-commerce shows no signs of letting up. And I think this reflects positively on the industrial sector. With rents and capital values, still expected to continue to rise. I think something that the pandemic did do was really reinforce, how important, how critical it was, to the overall movement of goods. And I think it just brought it even more into, sharper focus. We've seen the main occupiers being retailers, parcel delivery services, and other 3PLs, and they take up a big chunk of the take up there. Yields are now expected to stay lower for longer. I think it's fair to expect that. And rent growth, it's been on a strong trend for a long time, but it's expected to continue, but just at a softened level. So I think all round, it's a fairly positive picture for industrial going forwards. When we see when you compare yields being achieved on industrial versus retail, for example, now, you do start to think about, where are the opportunities with industrial versus, retail is starting to look, quite interesting again. So I do feel like we're close to that point, at the moment. Moving on to the office sector, I think here again, it was seen, big changes pre-pandemic, and the working from home theme, had clearly started a long time from that. We obviously had some trends around serviced office accommodation with actors like WeWork, who were well reported in the market, and that is something that is going to continue and going to become more predominant in the market going forward. I think the hybrid working model is the new normal. It will be the future. People and employees want flexibility now, and businesses with the effects of the pandemic are now much more well set up to cater for it. So we see a lot of the multinational corporations really forcing this hybrid model, and then what you'll see as a result is this real transformation of the workplace, where it molds itself to its new requirements. So it's less about sitting at your desk all day; it's more about being a place of collaboration and joining together of ideas and things like that. So I think that'll be a really interesting development, in office space going forward. And I think the demand that we're seeing in the market is already reflecting that. Where the high grade flexible space is really what's seen to be in demand. And the last point there really on that slide is just around, what's going to be the impact on overall demand for space. And I don't think it's as simple as, less people are going to be in the office, so they're going to need less space. I think it's more about, the densities are going to reduce. However, the proportion of space per individual is going to increase. So there's going to be some middle ground there, really, where this is going to sort of settle down. But I think going forward, we need to see and wait and see where that lands. On to the residential side of things. It's been an interesting ride for residential. Arguably, and certainly, my view is, I'm not sure the residential market necessarily needed the stamp duty break that it got, but it is what it is. I think the pandemic obviously forced a lot of people to reassess, their accommodation, their residential accommodation, and think about, how they wanted to live their lives. And I think what we saw certainly during the first part of the pandemic was, this flight to the suburbs and even beyond that. That's obviously led to a spike in demand in those locations. Whether that's going to be a sustained shift in the residential market, I'm not so sure. I think there's probably a bit of a knee-jerk short-term reaction to it. It may continue, to a degree, but I think, there will still be people who enjoy being, in the city centre with a vibrant location and access to sort of amenities and facilities that they provide. As you see, on the next point, the house price is rising by 13% in a year, and I think it's well reported that a lot of that was down to the stamp duty cut, and with that tapering off now, it'll be interesting to see where prices actually settle. I mean, I think the two factors which do persist and tend to combine and underpin values are the lack of supply and low cost of borrowing. And to my mind, I don't think these are things that are going to change anytime soon. So that for me is something that should buoy the residential prices. So moving on to the Thames Valley itself, I mean, I think the overall picture for Thames Valley is positive. I think it's mirroring a lot of the trends in the national picture. I mean, I've taken some stats here. I mean, Vale Williams, I give them credit. I'm not taking any credit for these stats. Vale Williams produced a really detailed and interesting report, providing the stats. But I think not to sort of just read off the slide, but I mean, you can see the prime office rents are generally stable or trending stronger. And again, the point around the flexible shared space, buildings, high spec, these are the properties that are commanding that rental premium. And we've got the likes of places like Windsor, which are kind of leading the way, achieving rents of sort of £43 a foot, which is a very strong level. I mean, what we see generally is a range, the range above sort of 25 to 40, really. So to get above 40 is a really good figure. But what you see is, again, is this really binary market where you've got the real good quality space doing very well, but the secondary quality space is suffering. The demand there is falling, and the rental values are at best stable, but on the whole are decreasing. And certainly when you build incentives into that, some of the rent-free periods, and the other incentives that you could be offered. So I think there is an element where the owners of secondary grade office space need to think about how they future-proof those buildings to cater for this new market. And interestingly, out of town business parks have proven quite popular in this new environment, and we've seen a big increase in out of town take up in Maidenhead. But that said, the focus really for me is with offices is on the high quality space, and that's where the demand is, and that's where the focus is right now. We see the yields for the sort of M25 area standing pretty stable now. I think they've been at sort of 5.25, 5.5 for a good sort of 3 to 6 months, with secondary 7%, but trending potentially upwards. Moving on to the retail side of things, and again, I borrowed a little bit of content here from Thames Valley Chamber's website, because it was really interesting. But again, you see that national picture being reflected locally, with a lot of the 650 operators disappearing in the first half of 2021. and really, some of these structural changes around shopping habits, which are really impacting on real estate. And I think for me, the important thing is how real estate reacts to this. I think historically, real estate has always been quite slow to react to these things, and I don't think there's the opportunity to be slow in terms of reacting to this situation right now. I think you see already some shopping centres and things like that which have been hit hard, by the pandemic. There's a lot of ideas that are being thrown around in terms of what the future of shopping centres look like. Are they more lifestyle venues? What sort of services do they provide? It's more a bigger leisure element in there. Who are your anchor tenants and things like that? Gone are the days when you're going to get department stores anchoring big shopping centre schemes. There's going to be a huge lifestyle element to things like that. Once again, the retail parks have proved more resilient, but to the point around who the sort of tenants that anchor these schemes, with retail parks, it tends to be grocery stores, DIY stores, home furnishing stores, which have obviously performed very strongly in the pandemic world. So that's a positive to come out of this. I mean, the Southeast as a region has been relatively protected, and it's been quite resilient. And that's principally down to, I guess, the London commuter population probably staying close to home through the lockdown periods. I've just sort of stated here some of the real yield ranges just to give you an idea. I mean, high street yields 6.5%, but trending upwards. Moving out towards 8.25 to 8.5 for more secondary locations, and you could argue a little bit higher for those. Shopping centre yields, I mean, you can see the impact there. I mean, the contrast for me is really stark when you think about prime industrial yields, down at sort of 4%, and shopping centre yields 8.5 to 10. I mean, it used to be the reverse situation, probably 10 years ago. So you can see how far the inflection has happened in the market there. But I think there's still probably a bit to come off in terms of retail. But I do feel, like I said at the start, that we are reaching the point where potentially there could be some interesting opportunities around retail with the right appetite for risk. Moving on to the industrial sector, I mean, I'll canter through this. I mean, it's just positive all round. I think it's to the point now where there are supply issues. There's positive things coming out every day about industrials in terms of you've got things like data centers which have been a big part of take up. You've got new industries coming into the fray here with film and post-production industry, which are all putting pressure on the demand side of things, and the supply is still quite limited. So what the landowners and the industrial property owners are now sort of thinking about is how do we increase that supply, and some of the things that are being thought about are, things like increasing the height of the units, increasing the floor space within the units to really maximise the use of the space. So that'll be an interesting development going forward. But I mean, you can see here prime industrial rents in £10 per square foot in Newbury, £18 per square foot in Park Royal, both trending very strong and positively, and occupier demand is high across the board. So I mean, I think overall the picture is really positive. I think industrial, the one cautionary note there is really just not to get too carried away. It is the pricing is strong, but the fundamentals are very, very good. And just moving finally on to the residential side of things, for the Thames Valley region, I think you could argue that it's probably benefited from the flight from London, where a lot of the city workers have sort of moved out to the suburbs, and obviously the stamp duty holiday kind of encouraged that. I think that lifestyle theme will remain going forward. I think everybody now has an awareness, because they've spent this time at home, They've realised the compromise that they make in their life with travelling as well, to and from workplaces, and the fact that they can be more efficient in terms of working from home as well. So that I think that this will will continue to be a theme, and for a region like the Thames Valley, it can only be a positive thing. I think it's fair to say that the Thames Valley corridor itself saw a real surge in demand as the buyers sort of sought to meet their new criteria. Some of the sort of Thames Valley towns and villages have seen price increases of 5 to 10% above the 2017-2018 peaks, which is incredible, really. When the population's locked down and there's uncertainty on the economy, etc., but people are prepared to pay this sort of money for for housing. So it just shows you the strength of that demand. Some of the hotspots that we've seen, and this is I've spoken to a couple of valuers on our team on this, but Hungerford in Berkshire, Wallingford in Oxfordshire, Farnham, Surrey, Oxford, obviously, and Reading. All of these places seeing really strong price growth. Looking forward, I think as I said a couple of times, I think Thames Valley is likely to mirror that kind of national picture. I think potentially prices may fall away a touch, and I think that's only natural following the stamp duty holiday phasing out. But I really believe that that the continued kind of constrained supply dynamics, coupled with those low borrowing costs, are going to stop them falling too far. And that's all from me, really. So I'll hand you back to Sarah.
Thank you, Ian. Right, we have a very brief time for Q&A, and I think actually it's me asking most of the questions. I have put a couple in the chat box. Can I go to Simon first before we wrap up? And don't forget, people, we can ask questions afterwards, and we will happily forward those on to our esteemed panelists. Simon, you mentioned, you need to get it in writing. Does email count as in writing?
I thought that was a really great question, Sarah, because
thank you. I thought it was a stupid question, actually.
No, I thought that because it just goes the ease in which you can make a mistake. I think here we were, because the reference to the blue and pink paper, we were talking about break clauses, and the chances are that an email will almost certainly not suffice, because if it said in the clause paper, an email clearly isn't paper. But it probably won't say that. This is a silly example that I gave, but what is relevant is that you need to look at the notice provision in the lease, and you need to comply with that to the letter, and almost certainly email will be excluded.
That's very interesting, and I have actually heard it before through divorce courts, etc., that you can't text, and emails are inadmissible. So
it's bizarre, and I often think it's kind of a bit pointless, but inevitably email is not allowed. So
hard copy is best.
Well, I think again, you need to read the lease, because it might be permitted.
Cool. Thank you, Simon. Ian, it's not really a question, but actually what you touched on, I think, was interesting, in as much that a lot of this, certainly around retail space, was being mentioned pre-pandemic, that the high street has to change, that it has to provide more of an experience, a kind of go-to, not just for shopping, but places where people take their kids and families. So there's something to do, and something to eat, and something to shop in. And I'm guessing that's what's happening with the likes of Debenhams, and I think in Reading, House of Fraser, I think, are even closing floors down. So does that sort of ring true up and down the country, do you think?
Yeah, absolutely. I mean, I think that big considerations around the overall shopping experience. You know, there's got to be some pull factors to get you into these places, whether it be the high street or the shopping centre. And you know, I think at the moment it's you know, the market's trying to work out what the best pull factors are, and what will tempt the customers to their locations. You know, there's got to give them a reason to go there, over and above, you know, the convenience of, you know, the online shopping thing. So I think a lot of that lifestyle stuff, you know, and even it comes back to a lot of the take up of retail at the moment is things, you know, things like beauticians and barbers and things like that, you know, and personal health and well-being. You know, these are the sorts of tenants that are picking up these vacant shops. So, you know, there's a whole, I think there's a whole sector of the market that can really capitalise on this, given the right location and opportunities.
So it's stuff that simply can't be delivered online.
Exactly.
Unlike when I ducked out of the meeting very briefly because Amazon turned.
They always
Sorry,
turn up
people.
at an inconvenient time.
I know. I should learn to leave a note on the front door saying, please deliver somewhere else for a minute. I just want to say huge thank you. I'm sure there'll be more questions coming in, and of course to our panelists. I will pass any on, but please do, you know, get in touch with me, get in touch with our panelists for further information. I'm just going to wrap up now with my last slide, because I've got 2 minutes, if that's okay, unless anybody's got any other questions coming in, but I can't see any. Just to talk very briefly, and it will be brief, upcoming events. We've got, for those of you Oxford-based people, Simon, that might be applicable to you for sure, but I'm not sure. East Oxford, depends where you live. The QE, thanks, Sarah. The Quarterly Economic Survey. So, and again, you speakers have actually touched very eloquently on this, that actually, and certainly Crowe, gathering that information forms an awfully important part of how we kind of shape what's happening next year, and the information that we deliver to the British Chambers of Commerce, who have the ear of central government, obviously. And then I think there's a webinar, I can't quite see it, but again, links into what we've been speaking about today. I will let you all go. Thank you so much for your time. Any questions? You know who I am and where I am. You've seen the whites of my eyes or the reds of my eyes, because it was a late night last night. Thank you.
Thank you very much. Bye-bye.
Thanks everyone for joining.
Thank you.
Bye-bye.
Bye.